All right, guys, I wasn't going to do a video on this because I've been covering this constantly, live stream after live stream, video after video, month after month, week after week. But a few folks have been asking me my opinion on what the Fed decision was. Actually, a lot of people weren't even sure how to interpret it, and I don't blame you. So in this video, I'm going to give you my take on the Fed decision, what I think the market will do. Will we still see a Santa rally or not? And how you can protect your portfolios going forward, regardless of what happens. You definitely want to stick around until the end of the video because I will be discussing some methodologies, going over example plays and whatnot. If you get anything out of this video, leave it a big fat thumbs up just like this. Let me know in the comment section, guys. I love hearing from you. Let me know what you think of the Fed's decision, where you think the market is going. So this is kind of like I said at the outset, I don't blame you for not really knowing how to interpret what Jerome Powell said. And the reason is this. So on November 30th, way before the Fed meeting on December 15th, Jerome Powell intelligently telegraphed what the Fed would do because he knows that if on December 15th, that was the first time you heard of somewhat aggressive policy, that can cause a huge shockwave to the markets and potentially shockwaves in parts of the economy as well. So on November 30th, well before that December 15th meeting, Jerome Powell not only said that it's time to retire the word transitory, which means temporary, right? Alluding to inflation being temporary, but he also said that the Fed is now going to commit to a faster bond buying and could could raise rates earlier than expected.
Few years, inflation averages 2%. So I think we can say that is taken. It was not the case going into this episode. It would have been many years since we had inflation at 2%. So I think the word transitory has different meanings to different people. To many, it carries a sense of short-lived. We tend to use it to mean that it won't leave a permanent mark in the form of higher inflation. I think it's probably a good time to retire that word and try to explain more clearly what we mean.
This is so funny. This is like who was it? Was it Bill Clinton back when he was president said it depends on what the definition of is, right? I think it was during the Monica Lewinsky scandal or some scandal that he was involved in. But he was, trying to get the media and the public on some sort of technicality, right, of the meaning of the word is. So he was saying that, transitory, the way that they were using it was that it wouldn't be permanent. But that's not the way that, the public interpreted it. So really, it's time to retire it because there's a misinterpretation of the word. Anyway, neither here nor there, just hilarious. So then Papa J. Powell springs up on December 15th and says, yes, faster taper. You guys knew that. We're going to taper at a rate of $30 billion. And we are going to likely raise rates sooner than expected. But he also hinted at faster rate hikes. So initially, we knew that there was going to be some sort of rate hike. I think most people within the Fed, most employees of the Fed and presidents of the Fed were banking on a 2 rate hike scenario in 2022. But now the Federal Reserve said that they are likely going to do 3 rate hikes. But the real important part is not really how many rate hikes. It's what is the rate that they're trying to achieve? Because whether you divvy it up, into 2 or 3 or 5 rate hikes, it doesn't matter. What is the end goal that you're trying to achieve? So the Fed is shooting for a federal interest rate of 0.9% in 2022 after all of the rate hikes are taken into account. They're obviously not going to do this in one fell swoop. They're going to divvy it up. So again, I don't really blame you for being somewhat confused with the messaging there because he did telegraph a more hawkish position and he came in and even sounded more hawkish, but he really couched it in terms of using a narrative that this was already telegraphed. There are no surprises here, but I don't think that the markets were expecting a 3 rate hike to 0.9%. However, he did still say that they see inflation dropping to 2.1% in 2022 from almost 6% that we had in 2021. Now, it is no surprise here that the NASDAQ took the brunt of that because the NASDAQ is full of mega cap tech stocks, the NASDAQ 100, right? And here we're looking at the triple Qs. This is just the ETF that tracks the NASDAQ. So today, the NASDAQ dropped over 2.5%, one of the biggest drops this year, one of the biggest single day drops this year. But because mega cap tech stocks don't do well in high inflationary environments, which we are in, and they don't do well in high interest rate environments. So it was expected that the biggest shock we would see is to the NASDAQ. Now, this isn't so bad because we're still at the 50-day moving average. We haven't breached any major support levels. So folks saw a green day yesterday and were rejoicing, then a red day today and they were crying. But really, it's still trading within this range. And this is the all-time high. Where we're at now with the NASDAQ was the all-time high just a month ago. So perspective is key here. Now, the S&P 500 also took a hit, but it hit the second highest level of all time today before taking that hit. And the Dow Jones took the least hit because the Dow Jones has more value stocks embedded within the index itself, and value stocks tend to do better during high inflationary, high interest rate environments. And obviously, we still have the new variant, which is supposedly raging across the world and now in the US. However, all signs and indications still point to current vaccines working effectively against them. So with that said, could we see a Santa rally? Yes. If you watch my last video going over Larry Williams' historical data, 22 out of the last 23 years, we start to see a Santa rally by T-minus 7 trading days left, which would put us this year around December 22nd. Now, does that mean it's going to happen? No, of course, that's just historical data. But the best indicator of future events is past events, right? So we only have historical data to go off of. And obviously, that does not include Omicron, which up to this point, the market isn't really pricing in since, again, the vaccines, all the news indicates that the vaccines that we have currently fights against this variant. And as our friend Jim Cramer said, he basically said that after the Fed's decision, after Jerome Powell's speech is now out of the way, there isn't really anything to derail the market between now and year end. Of course, there is towards the last few days of trading, you do tend to see accelerated selling. That happens year after year because what people are doing is called tax loss harvesting, basically selling their shares, locking in losses so that they can offset some of their short-term and long-term capital gains tax. All right, so what can you do to protect your portfolios? Well, everyone is in a different situation here, right? And please keep in mind, I'm not a financial advisor, but I do have a lot of experience and I run a trading group with 4,000 people in it. So I tend to see traders of varying backgrounds, experience levels, etc. If you came in the market very late, i.e. you're buying the tops, even if we're talking about the major blue chip stocks, then you are in a much different position than someone who has a good cost basis, right? So just because you bought NVIDIA or AMD or a blue chip stock does not mean that you're going to be in profit for perpetuity. That does not mean that you're immune from drops and even crashes, right? You're coming in at the top. However, if we do see a market pullback or a market correction, these are times that allow you to rebalance your portfolio. You want to have a portfolio that is solid and ironclad for the long term. I suggest that you go and find a dollar cost averaging calculator. There's one that I really like on buyupside.com, but basically it shows how dollar cost averaging could work over the long term. So if you're planning on investing for the next 10 years, we'll take the last 10 years as a benchmark. Say that you invested in Apple since 2011 and you put $1,000 up front, $100 a month. If you calculate your returns, you'll see that on a $12,000 invested amount, you made $84,000. So you basically, 7x your money on a $12,000 investment. And that's just putting in $100 a month. Obviously, if you have a job that pulls in even more significant income, then you can multiply your gains by what you see here, or potential gains, I should say. So sit down, look at a portfolio of stocks that you have high conviction on, and be honest with yourself, right? Just because you bought a stock and you overloaded on it does not mean that you have a high conviction in that stock. You have to be honest with yourself and say, okay, shit, I was caught up in the hype in 2020. I bought Jumia when it was $30 or $40. Now it's trading at $11. Is Jumia better to hold long term than an Apple or an NVIDIA or a Microsoft or a McDonald's or a Nike or a Lululemon or whatever? And the answer is probably not for a significant amount. Same thing with Skills. Same thing with DraftKings. Same thing with, take your pick of whatever was hot last year. Wow, I didn't know Skills was trading at $7.80. Does Kathy still own this? Probably that's why it's at $7.80. All right, I'm just playing. And if you're lost on what's a blue chip, go find a niece or nephew or one of your kids, if they know how to talk yet, and ask them. Say, hey, rattle off some brands. Name me some brand names that you're familiar with. Most likely your kid is going to say Apple, Starbucks, McDonald's, Nike, Microsoft, whatever, right? Those are probably blue chips. But if you really wanted a more, scrutinized and sophisticated method of picking blue chips, then look at what's in the SPY, what's in the NASDAQ. You can easily look this up. If you go SPY ETF, right? Look up what's in the SPY ETF. There's a really cool site called ETF.com, which literally you can look up any ETF and see what are the top holdings in there. And you could see that the top holdings are Apple, Microsoft, Amazon, Google, Facebook, Tesla, Nvidia, Berkshire Hathaway, JP Morgan, right? Those are the top, 7, 8 stocks in that index. Same thing for the triple Qs. If you go QQQ, ETF, let's see what's in here. Again, a lot of the same names, but different weightings. Apple, Microsoft, Amazon, Tesla, Nvidia, Google, Facebook, Adobe, and Netflix. And start learning how to read balance sheets and income statements. Look at the health of the company. Look at how much cash it has. How much revenue does it pull in every quarter? What are its earnings like? What is the valuation like? What is its growth, right? You want to see what its growth rate is. The good news is if you're a new investor, you have time, right? And the market isn't going anywhere. And the market, even if we do get a Santa rally, is likely to see a correction at some point. Now, what I like to do is every time the market hits a major moving average, right? That's when I reassess things. That's when I load in heavier on my blue chips. That's when I go in heavier on the indexes, because it's not often that we hit these major moving averages. If you want to learn how to pull up moving averages on a chart, watch my TA video here. So yeah, make sure you are rebalancing your portfolio so that you are happy with it, so that you see these steady growths. Right, the indexes grow. The major indexes, the S&P and the Nasdaq, they grow at an average of 10 to 12% every year. That's insane. And over time, you will notice, especially if you have a job and you're putting some of your income into these investments, which is much better than cash, because as Ray Dalio said, cash is trash. After 10, 15, 20 years, you'll look at, just as we saw with that dollar cost averaging calculator, you look at your account and be like, holy shit, I have that much money? All right, next thing, if you are short term, then yes, you will want to take some profits off of the table. I mean, look at where we're at. We're near all-time highs now. Even if we see a Santa rally, right? Like, what is going to be the average return for the rest of 2021? 2022, we're going to see a high rate environment. So the market will likely be a lot choppier than it is this year. Savings accounts are going to give a higher percentage. Bonds are going to give a higher percentage, right? So you'll see people start to diversify their money. And instead of just pouring it all in the stock market all at once every time, they're going to now put it into more fixed income based assets, because those are paying a much higher percentage than they were in 2021 and 2020. All right, next thing. A lot of people obviously use options in order to hedge their portfolios. I certainly do. I know a lot of the people in the group do. I've taught thousands of people how to trade options. But there are different ways of trading options, just like there are different ways of trading stocks. Obviously, you can have longer term swings. You can trade spreads. You can do diagonals and calendars. You can also do day trades. I opened up a new day trading account, day trading options channel, on the Discord, where I'm trying to teach people how to hedge and play both sides of the market. You obviously can do this with a paper trading platform. Do not commit any real money until you are confident in what you're doing. And we have the most tools to our disposal now. You literally have charting platforms. You have paper trading platforms. You have analysis tools, option flows, dark pool data, whatever, right? But you have all the time in the world to learn. And there's no better time than if the market starts getting a little bit choppy next year. So here's an example of how I set up my daily watch list on options day trades, right? I look at levels and I start determining whether I'm going to buy calls, which are bets that the price is going to go up, or puts, a bet that the price is going to go down. And if the stock breaches those levels, either to the upside or the downside, then that will determine what option I enter, right? Now, obviously, this is a lot harder, a lot easier said than done. It's a lot harder than it looks, and takes, months and months and months of practice, hours a day. But if you want to do it, you will get there. So just today, a down day like today, for instance, Lucid broke my actual support level, and I said that I would buy the 40 put if Lucid breaks the support level. We made 100% on that trade in just a few minutes. Same thing with the SPY. If the SPY broke my major support level, that I would buy a put. Let's see, which put was it? It was the 476 put. See, I said I'll buy a 474 call if we get over 473, or a 467 put if we get below 468. And we dropped below 468, as you could see here. And I bought the 467 put. We made 65% on this, again, in the span of a few minutes. Now, Again, I know this is easier said than done, so I'm under no illusion. I'm not trying to say that this is easy. I'm not trying to say that everybody will be able to do this even. Just like, a lot of people are not going to be good at basketball or good at golf. It really takes a lot of practice. However, it behooves you to learn some of this stuff if you want to take this to the next level. And the best time to learn is during down markets or sideways markets. Now, more conservative approaches using options, you can also sell calls against your shares. So if you have 100 shares of Apple or Palantir or Tesla or whatever, you can sell calls against your shares because those short calls will be backed by your shares. So if you have 100 shares of Tesla and you sold a call, let's just say at $1,200, if Tesla never hits 1,200, well, you get to keep that money. So you're making your shares work for you. If Tesla hits 1,200, then you are going to be obligated to sell your Tesla shares, but you're selling them for a profit at 1,200. So it is really a win-win situation if you own 100 shares of a high conviction stock. You can also buy protective puts as insurance. So if you own a lot of a certain stock, you don't want to give up your shares, but you think that we're going to see some downside, well, you can use a portion of the total value of your shares and buy some puts, say for 1 to 5% of the totality of those shares. In the same way that you would buy car insurance for a small percentage of what your car's value is, right? It doesn't make sense if you buy car insurance for the total value of your car, but you spend a small amount every month in order to protect your car. The same could be said for options and hedging against your assets. Anyway, traders, that is it for this video. So in conclusion, I do think we might still see a small Santa rally. I don't think that we're going to moon, but I do think that 2022, we will see a lot more choppiness. It will likely still be maybe an up year, but again, it's not going to be what we saw in 2020 or 2021. Most likely we will see some chop, but again, we trade every side of the market. We are equipped with our tools. If you want access to all of our trades, link is in the description below. If you want to learn how to trade options, come join the community. Over 4,000 traders. We talk options, stocks, crypto all day, every day. Long-term investments, short-term, YOLO calls, hedging, earnings plays, responsible investing, etc. Come join the most wonderful group, in my view. Hit that thumbs up if you get anything out of this video. Leave a comment down below. Let me know what you think about the market, the direction it's going. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.